The majority of millionaires are made in real estate. The majority of billionaires are made in private equity. And the point of this video is to walk you through the money-making process that they use to make tons and tons of money for themselves, tons and tons of money for their investors, and most importantly, accelerate value in a business. So let's walk through an example that everyone probably understands. So if you were to buy a house and you wanted to use this as a real estate investment, then you make money on this in two main ways. One is that the value of the house goes up. So let's say it's worth $1 million, it becomes worth $2 million. Great, we had appreciation. The other is that you get checks for $1,000 a month from the tenants, right? But the point is that you're going to get paid every month for some sort of production from a renter, and the house is going to go up in value. Now, if you just did your own house, then you're just not paying this, or you're just paying the bank for your mortgage and whatnot, and you're pretty much just going to make your money in appreciation. There are some things that you can have appreciation that just happens over time, and the other is kind of forced appreciation, which is where you fix the stuff, you clean the windows, you add a kitchen, you do work, right? And then it increases the value because somebody else might be more likely to pay for it or buy it. All right. Very, very simple. Now, the thing about real estate and why I think it makes so many millionaires, it's a really simple business model. Like, buy the house, put a certain amount down, you take a loan for the rest, as long as you put a tenant in that can cover that. Now, I'm obviously simplifying this, but that's because that's the point. I'm simplifying it for the point of the video. Plenty of people have lost their asses in real estate, but because it is a reliable thing, they're not making any more land, and they do keep making more people over time, as long as population growth continues, real estate will be a really good investment. Okay. Now that is a big fucking asterisk because of how population growth has been happening. Look at Japan's real estate market, for example, because their population has declined. We take some of these things to be true. We assume that humans are going to always have more humans, but that's not always the case. Okay. Now, our second example is, let's say that we have a business. So let's see if I can make a really simple business storefront. All right. We'll make that my little business storefront. All right. Oh, is that kind of business? No? All right. There's my business. You don't like my drawing, deal with it. And so, interesting thing with private equity is that there's more ways that you can make money. Number one is you can buy businesses with a much wider range. Like, a house isn't going to go for sale for $1, but businesses do sometimes get given away for free. More.
We just did this. So our current property, Douglas Forest, we bought it for no money down, 100% owner financing. So this is not just an example that's kind of like pie in the sky. Maybe this could happen. Ranger, we're only paying 30%. I think it's even less. It's like 20% over at K River. So you're not paying a huge amount for these companies. And what we're buying, we keep saying we're buying real estate. Well, we're buying a business that owns some real estate also.
Or less. And that's also because there's no debt. A lot of times people buy houses, they have debts that they have to pay back, and that kind of fixes pretty hardcore where people's kind of bottom is. They're like, well, I'm not going to lose money on my house. Like, fine, I won't make money, but you have to at least pay the bank back. Of course, the market still dictates prices, but I think there's still a strong line that people will hold in negotiations, which slows down crashes in real estate. Whereas a business can go from being not valuable at all to 12 months later being worth hundreds of millions of dollars. Let's say it's a technology, or let's say it's a patent that goes through, or some sort of pharmaceutical thing. That I'm giving you extreme examples because you're like, wait a second, how does this apply to my business? Well, if you didn't have a way to reliably get customers, and then all of a sudden you find a channel that reliably brings you customers, that makes something that isn't valuable incredibly valuable.
So this applies to us. If you don't have any customers, or you don't have a way to get customers, then that decreases the value of your business. Well, all the products that we look at, they're not doing online marketing. They're not doing online booking. That's two humongous ways to get customers.
Right? Or you hire one key person in the business that expands a new territory for you. Makes something that was once a risk. And the thing is that a lot of times businesses accelerate in value, kind of like the forced appreciation. You know, when you build in a kitchen or you build in a bathtub or something, the forced appreciation in business sometimes takes a negative and then turns it into a positive. And so what was once a risk then becomes a pillar of value. And so when you're thinking about accelerating value in business, and this is what we do at acquisition.com, is that we think through what are all of the negatives, what are all of the risks associated with this business. And then if one by one we can flip the risks into pillars of value, then we kind of get counted twice. So instead of a negative discount on our value, it becomes a pro and adds to that multiple. And so this is kind of the big difference with private equity versus the house, right? With a house, you can't change the neighborhood. right? Maybe the neighborhood can slowly change over time, but you can't take it and then put it in Manhattan, right? It's just going to be where it's going to be. You can fix a couple things. So there's kind of an upside limit to real estate. You're not going to get a 100x deal in real estate. You can get a 100x deal in private equity all the time. And that's why the people who amass fortunes, the richest people in the world, know how to reliably create 10x, 50x type returns. And at least in their careers, especially the best ones, have had multiple of these 20x's, 50x's in big, big bets.
So we talk about all the time a 10% cap rate. And so he's about to go into EBITDA and multiples. We always talk about NOI and cap rate. So those two things are kind of a lot alike. As a matter of fact, I'm going to, everybody see this chart?
Yes, you see it.
Cool.
Yes.
So cap rate and the multiple in private equity, they're inverse. They're backwards. The lower the cap rate, the higher the multiple. And so he's gonna go into explaining all this. But I mean, if you look at the curve, you know, if you start down here, what we'd like to do is buy it around a 12% cap. A lot of time we'll buy it at 10% cap. So a 10% capitalization rate means there's a 10x multiple on the property. So we would say a 10 cap on the NOI in private equity, they're going to say a 10x multiple on the EBITDA. And he's about to go into EBITDA here in just a minute. Look how crazy this gets. As we go down, we can buy at 10, and through different ways we're going to go through in a minute. I'll come back to this chart. We can sell at something like a 6% cap rate, which is 16%, almost 17%, or a 17x multiple. So let's go back to the video. We'll let him explain some more, and then I'll come back over here.
And so let me walk you through how that would actually happen. So let's say you've got a business that's doing $3 million a year, all right? And let's say it's doing $1 million in profit. This business is not going to be valuable, like not that valuable, all right? So no institutional investor is going to want to buy this. It's too small. I mean, it makes money. Maybe it requires the founder, so there's key man risk. There's a bunch of other things, but like,
remember when we always talk about the people who own it are operating it also? So the 100% of the business running depends on one person or one couple, like a man and wife or something like that. Some one or two people that run the entire business, and it's 100% dependent on them. They don't have any operating procedures. They don't have any standard ways that they do things. They just kind of fly by the seat of their pants, mom and pop style. And this is a good description of a lot of the businesses that we buy. A lot of the RV parks we're going after fit this model exactly.
Finally, this isn't going to be a super attractive business. Now, a retail investor, meaning like some doctor or lawyer who's local, might want to buy this business as a retirement asset for themselves, not knowing what the fuck they're doing, and then lose their assets.
So we talk about that all the time, a retirement career. So whenever we talk about RV parks that are like 30, 40 RV spaces, and they're built out completely, and there's nowhere to expand, that's a retirement career for like a doctor who wants to get away from the city, go live on the property, manage it themselves. But in order to afford property management, and in order to afford what actually Hormozy here talks about, he calls it the virtuous cycle of high pricing. In order to create that high pricing, you have to have all those operating procedures, and you have to have a larger number of units to be renting out. So he's about to get into that.
Someone could give you money for it because they don't know what they're doing, but it doesn't mean that it's actually worth anything. It just means that you pulled one over on someone. All right. So the thing is that a good private equity investor realizes that this is not worth much to a potential acquirer today, but could become very valuable with a few small moves. And so if all of a sudden this business starts doing, let's say, $12 million a year, which would be $1 million a month, and then it gets to somewhere in the neighborhood of, call it, $5 million in profit. Okay, this is now a much more valuable business. And so this is the magic. This is how it works. Is that you could pick this up for almost $0. You wouldn't have to pay a lot to get a business that does $1 million in profit. Depends who you are, but fundamentally, like you might do some seller financing, put some money, a little bit of cash in.
Remember, this is what we just did. We just bought a 20-acre property with 100 RV sites for $0.
just $1 million a year in profit, you might put 500 grand down, like as a show of good faith. The thing is this thing's riddled with risk, right? A $3 million top line business probably has, I don't know, 10, 15 employees, like not a lot of people. And so it's not very reliable. It's very volatile. And so it just screams risk. And so risk means fundamentally the multiple that you ascribe to a business's profits is a direct correlation to the risk you ascribe to the business. So saying that the opposite way is how likely you think it will continue to make money if nothing happens. And so if the owner leaves, that's a material change to the business. How long do I think this business will keep making money when this person leaves? If I think it's absolutely guaranteed, there's no way this business doesn't make money even after the person leaves, then he's going to get a high multiple in the business. His revenue and profit are very valuable because they're really secure. On the other hand, if it's like, I think this could maybe burn down in 6 months, then it might get a 0.5 multiple, or it just realistically a 0 multiple in the business saying, I'll just take it over for you. I'll take it off your hands for you, right? Now, the thing is that sometimes the difference between these things doesn't actually take a ton of work. It takes some expertise, but like not necessarily a lot of time. And so if a company's doing these numbers, it's like, all right, we probably need to hire a CEO, you hire a COO, probably need to bring in some sort of director of marketing to run sort of some of the day-to-day for it. We probably need to, update sales ops in the business. We'll probably update pricing because they're probably mispriced, right? And because we update pricing, we can now spend more on marketing, which gets us more sales, right? And
are we seeing how this relates to what we talk about?
Yeah, totally.
Yeah, we're able to raise the prices because we do more marketing, which means we could pay more for marketing, which gets us more sales. And this is exactly our model. This is exactly what we do.
We run that little gambit. And sometimes something like this can happen in like, I don't know, 12 to 24 months. Not a very long time in terms of time periods. But here's the crazy part. This business is basically worth nothing. This business, and let's say that it's moderately risky. So it's not like this is not a bank. So it's like they're probably not going to go out of business. Not even going to cover that. But like 95% of banks are actually a very, very stable business and they make a lot of money. There's way more restaurants go out of business than banks. Let's put it that way. All right. But let's say that this business gets an 8x multiple, and this would be a $40 million business. Okay. So in what?
Did you guys catch that? He's got $5 million worth of profit, 8x multiple, $40 million business. So remember that 8x multiple.
World, do you know that you can go from something that costs you no money to 12 to 24 months later having something that's worth $40 million? Not many. And so fundamentally, this arbitrage that exists here, because it doesn't take many steps or much time to create huge step ups in value, that is where private equity investors make their money. This is where business owners who know how to play the game get filthy rich. And the thing is that a lot of people are just very intimidated by this word and these concepts, but this is all it comes down to, is that 99% of transactions are going to be some sort of multiple. When I say multiple of EBITDA is just a fancy word for right now, just call it profit. But in the private equity world, it's earnings before interest, taxes, depreciation, and amortization. Which is just the earnings before. This is the part that matters. Earnings. How much money you make before all this other stuff. So if you made money and then you get taxed differently in different states, would you say the business is worth more or less? Well, I can incorporate in a different state. Okay, well then I want to know the earnings before the taxes, right? Well, I just bought this piece of equipment, and like if I didn't buy the piece of equipment, we'd have more profit. Cool. Well, then I want the earnings before the depreciation that you're going to apply, right? That's the idea here. Okay, and so that means that there's two big variables that we can influence with a business: the multiple and the EBITDA. So basically, if we can increase how much profit a company makes and how reliable that profit is and growing, then we're going to get a higher multiple.
Okay, so this is how we do it with property management. We bring in an experienced professional property management team, and that's how we're able to raise the multiple and raise the profit. So we raise this profit and we make it more reliable because it's not dependent on the person who's living on site who owns it. Because whenever that person gets sick whenever they decide that, somebody in their family dies and they're gone for a month and the business starts to go down and has problems, that's less reliable. So you get a lower multiple. We can make it more reliable by having like a large property management company who could just hire new GMs. Say a GM gets sick, dies, hurt, quits, doesn't want to do it anymore. We have a big property management company to just go hire a new one that's more reliable. And also we're spending money on marketing, so we're growing. So we're growing the business, growing the profit, which is growing the multiple.
All right. And so let's say we have two businesses. All right, we'll say two businesses. Business number one, let's say they're both the same size. Let's say they're $10 million in top line revenue. Let's say they're $3 million in profit. So let's say we have two identical businesses here. This business is purely transactional, meaning it's one-off transactions. There's no recurring revenue. There's no annual revenue retention. It has one way of getting customers. It has a founder who's integrally involved in delivery and marketing and operations. So all three aspects of the business. So running the day-to-day, making sure the product's good, and making sure we're getting more customers. So one guy's involved in all of it. And they're going down. They used to do 20 million and 6, and now they're at 10 million rate. All right. So this is our $10 million business. So is this growing? No. Would you say that this is reliable in the future, that it's going to continue to happen? Well, the thing is that this business is basically unsellable. Like, it's not that it's worth nothing. It's just that it's worth nothing to someone on the outside. The thing is, to the guy on the inside who's making $3 million a year, there's value to the business. There's just not value to anybody else. And so that's the key here, is that when you're thinking about building the business, I want to make this valuable for anyone, not just valuable for me. So if you own a barbershop and you make 200 grand a year from your barbershop, but you're involved in the day-to-day, there's nothing wrong with that. I mean, you're meant to work. We're all meant to work, right? But it's just that I haven't built it so that it can be worth $200,000 a year to somebody else. If you can build it like that, then now you own an asset that has intrinsic value to the marketplace. Now, let's go through this other one. So this guy's worth zero. I don't know what that was. There. This is worth $0, unsellable, to this guy. So this one, last year they did 5 million. This year do 10 million, and they're pacing 20 million for this upcoming year. They'll do 3 million this year, but they'll probably do 6 million or 7 million next year. It's all annual recurring revenue. We think that the margins are going to expand as they get better because they're going to have economies of scale. And so we've got profits going up. We don't think the market's going anywhere. It looks reliable and it's growing. Well, this thing might get a 12x multiple. And so then this thing might be worth $36 million. And so then you're like, wait, how can these two businesses with the same size and the same profit be worth such dramatically different amounts? Because fundamentals of value creation. How reliable is this money that I'm going to be making, and how much of it is there? So if you have a lot that's not reliable, then you're going to get a small multiple and a big number.
So the way that we drive profit is by rates and occupancy. So to bring it, specific to our industry, the way that you drive amenities drives rates and occupancy. So amenities are a pool, nicer roads, a park, dog park, a nice clubhouse, a nice little shop, a nice professional little staff that wears little colored shirts that has the name of the RV park on it. These are all things that raise, that's not specifically an amenity, but like golf cart rentals, all the different things that we can add. We have tons of profit centers that we can add into an RV park to be able to raise the EBITDA, raise the profit, and be able to make it a more reliable business.
If you have a small amount of profit, but it's super reliable and it's growing, then you're going to get a big multiple on a small number. And if you've got a ton of profit and it's super reliable and growing really fast, then you're going to get a monster multiple. Like, fundamentally, that's it. That's how it works. Here's one of the other big things that people get with private equity is that with a house, you can't build a house from scratch. I mean, you can build a house from scratch, but it's going to cost you money. But a business, you can start with nowadays almost nothing. You can start selling your time, then you start making some money, you start paying other people, all off cash flow in the business, which the business can start for free. And so you can have something that literally costs you $0 that becomes worth billions. And there is no piece of real estate on earth that you can build for $0 and then it will someday be worth billions. And so the reason that private equity makes more money than real estate at the highest levels is because it requires more skill. Because there are more skills required in order to do it. Now, to be fair, this is in some ways just as strong as an advocate of real estate, is that it's a simpler business model. Now, people still lose money in real estate all the time. Just got to look at the forms. People lose money all the time in real estate when they get greedy. But in terms of reliably giving people returns over years and years and years, it has worked, provided population continues to grow. So if you are going to buy real estate, try and buy it in areas where people are continuing to either move to or have more kids. So fundamentally, there's only 3 ways that you make money in a business or make a business more valuable. Number 1 is you increase the number of customers. Number 2 is you increase their value, which I'll just say is LTV or LTGP, depending on what you say, which is how much they pay you over time. Third is decreasing risk, right? Which is increasing the reliability of the business over time.
Okay, so what this means to us is customers, that's our occupancy. How much occupancy do we have? We drive up the occupancy. That's how we create value. And then the value of a customer, LTV stands for lifetime value of a customer. And so that for us means rates. What's our average daily rate for the park? Increase our customers, increase our occupancy, increase our rates. And that's how we create these 2 value drivers. We bring down risk by putting in professional property management, and we raise reliability by putting in that professional property management. And then, of course, we improve the property. So we do the same thing in real estate. We do forced appreciation where we improve the property, but really nobody who's buying the property is looking at it and saying, it looks nicer, it has nicer windows, it has nicer doors, it has nicer roads. They're looking at the P&Ls, they're looking at the profits, they're looking at how much it costs, how reliable that is, and if they could buy the business, could they keep it running? Could they keep it growing? Could they make it worth even more than we made it worth?
And so whenever you're allocating money or time in your business, it has to circle up to, this is going to get me more customers. This is going to make them worth more. This is somehow going to decrease risk. And if you can't very clearly state how you know it's going to get you customers, how you know it's going to make them worth more, how you know it's going to decrease risk, then you have to ask yourself, is this the best use of my time, money, and effort?
So the way we increase customers is by marketing, online marketing, dynamic pricing, online marketing and online booking. That's how we increase our occupancy or how many customers we have. And then how do we increase the value is we make the place nicer and we raise the value. So that's our average daily rate. And so we know how to increase the customers, increase the value, or in our words, increase the occupancy and increase the rates and occupancy. Amenities drives rates and occupancy. We add amenities. Amenities are also online booking. How do we make them worth more money? Also, dynamic pricing. Dynamic pricing increases the value of a customer. One customer on the 10th customer on dynamic pricing is worth more than the first customer on dynamic pricing.
And this is where I think most people do this instead, is that they then spend money on stuff that's worth nothing. And that's why a lot of people don't get rich when they try to, is that they don't know where value gets created. And so you either have to make more money or you have to make the reliability of that money more valuable. Okay,
so this is a mistake that we've made on businesses in the past. We've spent a lot of money on things that do not make us more money. It doesn't increase the rates and it doesn't increase the amount of customers. So that's a mistake that we've made in the past. So as we're looking at RV parks, as we're going out and buying them, part of our plan is, as we're increasing the number of sites, which means the number of customers, and how nice they are, which means how much we can charge them, those are the value creators. That's what drives the value in the business, and that's what drives up the profits.
Make money by getting more customers, making them worth more, and then you decrease the risk associated with that in the future. So you're like, okay, well, I want to have that big amount of profit, but I want a massive multiple associated with my business. So let me just give you a couple of kind of like the big leaguer ways that people think about this. Acquisition.com is a family office that functions like a private equity firm.
Okay, so this is his commercial about his company, Acquisition.com, and he's got a, what do you call it? He's got one of those just like this, just a mastermind. It's out there in Las Vegas. It's very good. I've been watching his videos for years. I learned a ton from this guy. And so acquisition.com is a way that he teaches people all of this for free so that they can grow businesses to a certain percentage so that he can go in and buy them later and make them worth more. So everybody's got a plan. Everybody's got a scheme, right?
Your company that looks like that. How much debt your business can carry. So that's going to be a function of cash flow, right? And so if you have a lot of cash flow, meaning that you can take distributions in huge amounts every month, then it means that your business can support a lot of cash flow, which means it can support a lot of debt. So unlike, with your first home, there's like these fixed amounts that banks will say you have to put 20% down. And if it's commercial real estate, you have to put 35% down, whatever it is, right? There are these fixed amounts that they say you have to put down in order to limit their risk. But the thing is that with businesses, it's varied based on how much cash flow a business has, right? And so a business that has almost no cash flow, like, is going to be able to take on almost no debt. And one that has tons of cash flow can take on tons of debt, right? In a disproportionate amount. The second thing is organic growth.
Did y'all catch that? A company that has a higher cash flow can take on higher debt. What's part of our thesis? We buy an RV park that's half built, half empty. So it has low cash flow. So we take what's already existing and make it high cash flow. Then we can go and take high debt to do the construction on the other side. So a low cash flow business can only get a small loan. A high cash flow business can get a bigger loan. That's a fundamental piece of our investment thesis.
So this is the stuff that I teach on this channel, right? Which is like marketing, sales, pricing, all these things that we do. This is all considered organic growth. Inorganic growth is when you buy other companies in order to grow. You combine balance sheets. All right, but if you are growing as a business, that's going to give you a bigger lever on your multiple. I mean, you're going to get more for it, because if they know or they believe that you're going to consistently grow 20% a year, no matter what, for the next 5 years, then they know that the business is going to double in 5 years. So if they did nothing, they're going to more than double their money, because they're not going to buy 100% with cash. They're going to buy it with debt. So if you double a business and you put 20% down, then you could 4x or 5x your money on the business because of the leverage that debt gives you. This is all why these multiple levers increase how much you get paid. So the third one is categorization, which is appropriate for letter C here. If you are a business that is categorized as, let's say, a traditional service business, right? But you're able to build some technology into your business that allows your staff to get 10 times more done or handle 10 times the customers, then you have something that would be called tech-enabled service, right? Or sometimes even a true SaaS business.
Okay, so for us, our categorization, we also like to buy RV parks that are long-term. We like to make them short-term. So basically, we're changing the category. It's no longer like affordable housing. It's now hospitality, which is a resort. So this is how we change the category to increase the value of the business.
And so tech-enabled services have higher multiples than traditional services, and SaaS companies have higher multiples than tech-enabled services.
So us being we are also a tech-enabled service, a tech-enabled business, because we take businesses that are using no technology, no online booking, no online advertising, no dynamic pricing, revenue management, yield management, all of that stuff built into the AI of the business. We're a technology adder. We add technology to a business, and that's another way that we change the category or upgrade the category of the business.
And so how you categorize the business, if it's just moving one step over, which is, okay, let's just look at our delivery. Let's just invest in a little bit of technology so that we can get categorized differently. It might cost you $100,000 to get some streamlined processes and tech in place to help 5x, 10x the delivery. And if that's the case, then you got a $100,000 investment that might give you 3 more turns on your multiple. 3 more turns being like you go from a 5 multiple to an 8 multiple. And let's say you make $1 million a year. It's like, well, that added $3 million to your enterprise value for $100,000. It's a 30x return. So like, this is how you have to start thinking about it within the business. It's like, oh, this is totally worth it. So should I take this $100,000, put it in my pocket, and then put it in the S&P 500? Well, if you're a business owner, you can put it right back into the business in a way that you know you're going to get a good return on capital. So categorizing what type of business your business is really in. Next one is size premiums. This is one that a lot of people don't understand. When you buy wholesale in your real life, you buy 1 roll of toilet paper or you buy 20 rolls of toilet paper, the 20 rolls of toilet paper are going to be cheaper because you bought bulk, bought wholesale, right? Businesses are actually the opposite. If you put a ton of profit together, you get a size premium. So a business that does $100 million a year in profit is worth a hell of a lot more than a company that does $100,000 a year in profit. And a big part of that, believe it or not, is that the people who have the most money in the world have so much money. And this is very hard for like you probably grasp if you're not familiar with this, but like the people at the top, BlackRock, Blackstone, like all the big guys, all right, State Street, all that stuff. They have so much money that they have minimum check sizes. So I was talking to a friend of mine at one of the banks, let's put it that way, and their minimum check size now is 150 million. So not enterprise value. That's just the minimum. So if you have a $300 million company, they have to buy at least half, or they're not interested because they need to be able to.
Okay, so we're having this happen actually literally right now. The phone calls that I've been on in this past week, people can't write us 100,000 or even $1 million or a $2 million check. They need to be writing $10 million checks, and they want to write one $10 million check every quarter.
Yep.
So this is the size that people get to, and as we have 10 RV parks versus one RV park, we're not looking to buy one RV park and sell it as one RV park. You guys that are partners in one RV park are going to get the value from your one RV park from me as a group selling 10 RV parks all at the same time. And he's about to go over some of that, and we can go over the multiples. I'm going to switch back to the other screen and show you the multiples here in a second.
Or write checks of 150 million or greater because they have so much money that they can't waste time writing checks smaller than that. And so they pay a premium for operators to go in and gather a bunch of assets together so they can write one check.
That's what we are. We're the operators that go in and gather a bunch of assets so that a larger private equity firm can write us one big check. And they will pay a premium for that. And we'll get to the multiples here in a second.
I know this sounds insane, but this is how people make jobs with money, is understanding this other world. All right. And so this is why people are like, man, I've got key man risk in my business. I'm like, dude, you make $1 million a year. Of course you have key man risk. It's a tiny business. Like, this isn't where you solve that. We solve that when once you get to an institutional level, which by the way is about 5 million profit per year, is where institutional investors like begin to really take notice of business. Below that, you're not really going to get much. And at the 5 million mark, you might get somewhere in the neighborhood of like 25 to 40, somewhere in there. But like if you cross 10 million, it gives you a size premium. You get a little bit more.
Remember how I talked about our buy box is in between 1 million and 5 million? Didn't he just say institutional investors won't even look at anything under 5 million? So that means that we take them out of our competition completely. So now we're not competing against the big boys because we're under 5 million. And then of course the other side of that is over 1 million, it gets to be harder for another small operator to go in and buy it. So we can take out our competition on the low end and take out our competition on the high end by staying in that little our buy box. And there's a glut of these properties out there, and that's what's exciting to me. I had an hour-long conversation today about, these guys, just like he was saying, they're like, look, we can't do anything less than 10 million. Can you go find us some RV parks that are worth 10 million for us to buy? And I'm like, why would I do that? Those RV parks are already nice, running well, have good stable practices, have good value creation, which means that they have a high occupancy rate, they have a high rate, their high average daily rate. And so they're already kind of like maxed out. Why would I go buy a property, buy a business that's already kind of maxed out, unless I was buying 10 of them at one time just to have long-term stable cash flow, which is what we sell to. So what he's talking about right now, that's us. We are the aggregators, the ones that go in and buy a whole bunch of them, make them nice and standard, and then sell them off as a group, or it's called a packaged portfolio, to a larger group for a premium or a higher multiple or a lower cap rate. So all of these words across the different industries, it's important to know these different words, because if you're talking about NOI and you're talking to a private equity person, they might be talking about EBITDA. Well, you need to know that EBITDA and NOI are basically pretty close to the same thing. there's some very specific differences. They're not exactly the same thing. But for the purposes of this conversation and for the purposes of a conversation with somebody in private equity, whenever they say EBITDA, you think NOI. Whenever they say multiple, you think cap rate. And so you need to be able to communicate. It's almost like translating. You're translating from our commercial real estate world into the private equity world. You're translating between two businesses.
More on the multiple. So not only do you have a bigger amount of profit, you also get more for that profit. So it's like a double multiplier effect. And this is why people talk about patience all the time. It's like you could sell today for 25, but maybe if you waited a year and got your 5 million to 8 million in profit and you short up a couple things, you go from having a $25 million sale to a $75 million sale. One more year of work. So $50 million of enterprise value, 3x what you would have gotten paid for one more year of work. And this is how that compounding unlocks these huge numbers in private equity. E is age. So to further on my little speech there on patience, the age of the business also makes the business more valuable. And so think about it this way. Imagine there's a business that's 1 year old that's doing these numbers, and then a business that's 10 years old doing it. Well,
we see this all the time. We get businesses pitched to us, RV parks pitched to us all the time, and they've only been doing good numbers for 2 years, especially because of 2020. And so then they'll say, well, 2020 was no good, and neither was 21, and we were still coming back in 22. So like halfway through 22, we started to do okay, and then we're doing pretty good now in 24. So they'll have like a year or two of good numbers. Well, we're going to pay way more for a company that says, hey, for the past 10 years, here's how awesome we've done. So the same thing, we're going to sell for a lot more whenever we can show, here's 5, 7, 10 years worth of P&Ls. Here's 5 good years of P&Ls showing that this is a nice, older, steady, stable cash flow business. That's what gives you the premium. So you've got the size premium, the age premium, categorization, what we're doing, changing it from long-term to short-term, having the organic growth, which comes from all of our social media that we're doing across all the platforms, and then having a high amount of cash flow, which allows us to have a high amount of debt. And so debt is, you want to have more debt than equity. And so the big thing that a lot of people say, this is kind of like a little saying in private equity, is equity is the most expensive thing you can sell. Equity is the most expensive thing you can sell. Now, you folks who are all in my program, you're getting equity. So you're getting the most valuable thing in the business. Having equity in the business, that's the most valuable thing. If you were to loan us the money, then we would just pay you back with a certain amount of interest. But if you have equity in the business, that's the same thing for our investors. Our investors get equity because they get a piece of the carry. This is another one of those private equity terms or industry terms. They get a piece of the cash flow. They get a piece of the cash flow in the sale. That's what's called the carry. They get their pref, which is like interest, and then they also get a percentage. So that's why equity, being an LP with us, is very, very valuable. And all the people that are in my program that have invested, that's why it's very, very valuable, because equity is the most expensive thing you can sell. It's the most valuable thing you can get is equity.
You'll probably feel more confident buying the 10-year-old business because you're like, it's been around for 10 years. Like, it's not going anywhere. The managing partner at APG said this to me, and I never forgot. He said, a business always becomes more valuable every single year until it doesn't, and then it's worth nothing. And it was such a profound statement, which is basically like, as long as you keep growing, no matter how slowly, or even maintain, and the business stays around, the business is more valuable. So $10 million business at year 5, and then $10 million year 6, it's a little bit more valuable at year 6 because it lived another year. But the moment it goes down a little, it's worth nothing because no one wants to touch it unless you have distressed asset experts. I'm not going to get into that. Right? And so when you're thinking about your business, it's like, okay, I want to create lots of cash flow in my business. I want to have lots of organic growth. I want to grow. I want to sell more. I want to market more. I want to make sure that my price is good. I want to get efficiencies within my organization so that I can get categorized as a better type of business that has generally higher multiples. I want to get it big enough that I get a size premium so that I get more for each dollar profit in terms of enterprise value. And I want to keep doing this for a long time. And if I do all this stuff, I can make generational wealth in a number of years. And so, no, this is not the get rich in 6 weeks stuff. This is like get rich in six years ish. But the thing is, that 6 years, at least for me now, is like not that long. 6 years is not that long. Like you're still pretty much, you're in the same decade that you're currently in, right? And so when I think about it like that, I'm like, most people simply can't wait 6 months for anything. And I was telling one of the business owners here the other day about this. Is like the woman in the red dress. I talk about it all the time because it's been the hardest thing that I've struggled with in my entrepreneurship. Of all the things, that's been the hardest.
So he talks about this thing called the woman in the red dress theory. And if you remember from the movie Matrix, he talks about this all the time. If you remember in the movie, there's this training program to where they're walking down the street and this woman in the red dress walks past, and the star, Neo, the star of the show, gets distracted by the woman in the red dress and isn't paying attention. And then whenever he turns around, he's got a gun to his head. And so that's a lot of times what happens in business is, we're focused, we're moving forward. We see that woman in the red dress, we get distracted, and before you know it, we're completely off course. So that's what he's talking about.
And once you stick with something for 5 years, you get it. You're like, oh, I understand now. Now, it's not just saying you had a business for 5 years, because some of you guys are fucking looking at you. Do 6 other things all the time, and you have one business that makes you money, and you never paid all the attention you should be paying it to, because you're always busy thinking about these other opportunity vehicles that could be better. When in reality, think about the logical extreme here. One guy starts a new business or a new side hustle every 6 months. Think about the other guy. Does one business for 50 straight years, never does anything different. Who makes more money? You already know. Let's say you're 4 years into your business, okay? And you say, man, I have this opportunity that I could be doing so much more money. Okay, that's fine. But for you to do that, that means you're going to miss out on your 5 of your current business. All right. Now, what you're really missing out on is not only are you missing all of this, right? But the new business has to be able to do that year one. Now, maybe the new business does half of that year one, which is great. But again, now year 2, let's say you're a little higher there. That's okay. But this is what you're also missing out on. The line that would have been off this fucking graph right here is that this is the second year, and this is the second year from when you made the decision. And this is what people miss out on. This is what people don't get. This is why people stay poor, is they can't stick with stuff. Because a mediocre opportunity executed to infinity is going to do better than an inferior opportunity that you consistently switch to over and over again. And so the reason that these things create more enterprise value is that most of these take time. Even in the recategorization would take work and time. Almost all of these take time. And so if you just think about the logical stream of what your actions lead to, you can reverse it into the present of what actions will I get the most return for my effort. And that's how you can create a lifetime of generational wealth. And if this stuff about focus is hitting for you, I made a whole talk on this at my headquarters here in Vegas to a group of business owners about it. Check it out.
You can see this chart. It goes from 12%, and it looks like it's backwards. From 12% to 5% cap rate. Well, that goes from 8 times multiple to 20 times multiple. So a multiple is 20 times the value, the current income of the business. The value is 20 times the income of the business, the net revenue, the EBITDA, the NOI, the net, the juice at the end of the squeeze. And so one of the other things that we've been talking about, and I want to just keep hitting on it and keep hitting on it and keep hitting on it, is we buy in this range, 10, 11, 12, and we sell in this range, 7, 6, 5. So the reason we're trying to sell in this range, first of all, we bring up the value of the property anyway, because we bring up the amenities. Amenities drives rates and occupancy. So you bring up the amenities, that brings up the rates. You're also bringing up the occupancy. The occupancy you're also bringing up because of online booking. You're bringing up the rates because of dynamic pricing, which means customer number 60 is paying 10% more than customer number 50. Customer number 70 is paying 20% more than customer number 50. So rates and occupancy is how we raise the value. And then We also, by selling at a premium, size premium, if we're selling 100 pads, one RV park, 100 pads, we might be selling, say we buy it at 11 or 10, maybe we can get it to a 9. You know, maybe we can raise the rates and the occupancy and we can sell it for like a 9%, maybe even 8.5, you know? So somewhere in here, like 12, about, 12.8 multiple. But if we're selling 10 RV parks, which is 100 pads per site, per RV park, and we're selling 1,000 RV pads, now we're getting into 6 and 5. So we're looking at 16x the property value, the NOI, 16x the EBITDA, 16x the net. And then, I mean, if you can really knock it out of the park, really get streamlined operations, awesome property management, awesome online, and you're hitting economies of scale at this time. Because we're advertising 10 parks, we're going to be having all kinds of different websites that aggregate and bring our customers together so that our customers go to our other parks. They know that we have a brand. So now we sell an entire 10 parks, 1,000 RV pads, all as one package. And we've raised the income, the cash flow, the EBITDA, the NOI, whatever you want to call it. But really, this is the goal right here, 20x the NOI. So really, whenever we're talking about selling at a 10 cap, that's one RV park. The challenging thing is right now we have all of our RV parks are separate. It's separate groups. Over the 5 years that we own them, I'll be aggregating them. I'll do a takeout fund where all of them will be underneath one fund, one property management company, which you guys already know that, one set of dynamic pricing, everything together. So it's a package. That way we can get them up to like this 20x multiple. This is where we want to be. And I shared this with you. Hopefully you can open it. Let me double check and I'll make sure that everybody can share. You can all see it. Restricted, nope. Anyone with the link, okay. So now anybody who wants to look at this, y'all can look at this and use this in your presentations. Use this to study and really understand and dig in on what is a cap rate, a multiple, how they really work. And that's going to help you talking to investors. That's going to help you when you're looking for RV parks and you're looking at, okay, well, they show you the P&Ls and you look at the bottom and it shows net income. That's your NOI, your net income. Well, your NOI, we're going to be looking at something like a 10 or a 12 multiple. Oh, I'm sorry, that's a 12 cap. So we want a 5 cap. I'm sorry, we want to buy at like a 12 or a 10, and we want to sell at like a 6 or a 5, which means we buy at an 8 to a 9 multiple, maybe even a 10, but we want to sell at a 16 to 20 multiple. So we force the appreciation of the business, we raise the profit of the business dramatically, and we sell